A volatile week on Wall Street following the fifth interest rate hike from the Federal Reserve so far this year. Some investors and economists concerned a global recession could be looming. ABC's Deirdre Bolton has details.
Stocks tumbled Friday. The Dow Jones closing down almost 500 points, finishing below 30,000 for the first time since June 17th and at its lowest level since November 2020. S&P 500 shedding more than 4.5% and the NASDAQ down more than 5%. Energy markets also taking a big hit. Oil prices fell following a series of interest rate hikes around the world. Many investors and economists are concerned we may be heading for a global recession, which would lower fuel demand. U.S. crude closing below $80 a barrel, its lowest level since January of this year. The market turmoil comes as the Federal Reserve continues its efforts to curb inflation, raising its benchmark interest rate 0.75% earlier this week.
We have got to get inflation behind us. I wish there were a painless way to do that. There isn't.
This marks the fifth time this year the central bank has raised rates, making it more expensive to borrow money. The hope is that demand for goods and services will cool and therefore temper inflation. Americans paid 8.3% more for goods in August compared to a year ago. Rising interest rates are bad news for home buyers. The rate on a 30-year mortgage now double what it was in January, now above 6%.
The housing market doesn't do well in a rising interest rate environment. And that's because consumers are relying on mortgages in order to become a homeowner. And what we've seen since the start of this year is that millions of Americans have now been priced out of homeownership.
Also affecting consumers, the average interest on credit card rates now stands at about 18%. Deirdre Bolton, ABC News, New York.
This dramatic interest rate hike is creating concern for consumers. So what exactly does it mean for you? Ann Sparacco spoke to an expert and has some tips.
Rising interest rates are keeping some people on their toes.
We will have to budget ourselves more carefully.
Others say they don't have too many concerns.
No, I really don't.
The Federal Reserve increased interest rates by 0.75%, the third straight hike of that amount. Old Dominion University economics professor Bob McNabb says it's a way to drive down demand to help lower inflation.
The average consumer will see changes in mortgage rates, auto loans, even credit card use. But McNabb says there are ways to alleviate that financial strain.
Markets go into bear territory and they correct that it's usually 3 to 4 years before they regain the value that they lost. So if you panic now over the next 6 months and take all your money out of the stock market, you're actually locking in your losses.
McNabb says another thing to pay attention to is how you pay off your credit card debt.
Are you carrying a balance? Because now that balance is going to generate higher and higher interest.
He says it's best to stay calm with the tough road ahead.
Reducing what you spend, getting out of debt if possible, and watching your pocketbook are all things we need to do in the short term to get through this period of economic uncertainty.
In Norfolk, I'm Ann Sparacco for 13 News Now.
McNabb says depending on how the Federal Reserve handles interest rate hikes moving forward, we could enter another recession.